10 questions up to now. Do you guys have any questions on the exam? Well, let me ask a question. Is there anyone that did not receive the exam? The chapter 10 exam?
I got mine.
Yeah, I got mine too.
Okay. Okay. Well, if you have any questions, if you want to ask me later too, you can. But anyway, we'll go ahead and get started on the chapter 11 handout. And let me pull that up. I don't think we've done anything with this. I don't think we got to it last week. Fresh, new, complete handout. Okay. So accounts receivable and revenue recognition. So we're going to talk a little bit about accounts receivable and why they can be a little bit tricky. And the first one we start out with, ignore the funny spacing I have here, but so the normal journal entry for cash sales would look like this. So we have cash going up and we have revenues going up. So cash goes up with a debit, revenues go up with a credit. So this is the normal cash sale. Now, a sale on credit looks like this. Let's make it green. Notice you don't get the cash. We have accounts receivable. So this is what somebody owes us. So this is what we get instead of the cash. But other than that, the revenue is the same. The revenue goes up 1,000. Our assets go up by 1,000. It's just not cash. The asset is accounts receivable. Okay. So here's a question. Why is a cash sale more susceptible to fraud? Scratch that. Why is a sale on credit? I said it backwards. Why is a sale on credit more susceptible to fraud than a cash sale? What was the same as last time? So why would a credit sale, if you're an auditor, you're looking for proof of something, why would a credit sale be more difficult to nail down than a cash sale?
Cash is the most easily verifiable asset.
Yeah.
So if you try to do cash, you could easily use like a bank confirmation to confirm or deny. But accounts receivable, yeah, that's all I guess.
Yeah, a cash sale. If there's a cash sale, that means that cash came in. There should be probably some kind of a deposit, right, that goes along with it. So you can trace the cash to the deposit slip, those whatever it comes into, and verify that those are actually cash sales. The problem with accounts receivable is that it's much more difficult to verify, and we'll find out that most of the documents are made by the client. So accounts receivable are more difficult. Why more so? Because accounts receivable. There's no cash deposit, and all of the documents are created by the client. So your client that you're auditing, they make all of the documents. Oops. Hey, what happened there? So there's no cash deposit, so you can't trace it to see, okay, this is someone who actually handed us cash and we put it in the bank. And all of the documents are created by the client. So at least initially, accounts receivable are pretty flimsy when it comes to evidence. And we'll go over some of these documents and kind of see why. Okay, documents and controls over the accounts receivable and revenue function. Okay, customer purchase order. Sometimes customers will have purchase orders, sometimes they don't. For instance, you walk into Walmart, you're not going to have a customer purchase order. You're just going to go buy stuff. But so customer purchase order, these are made by now these are the customer of the clients. Create these. And they may or may not be used. So if this is IBM, create, how do I spell create? I think it is create, isn't it? Clients create. I'm going to do it this way. Okay. So customer of the client creates the purchase order. Now this one is, we would call this medium evidence. It's not made by the client. But the client will have access to it. So the client will be holding it. So it's probably medium evidence. Sales order. The sales order is created by the client. So if this is IBM, IBM creates a sales order. Now this is going to be low evidence, low value evidence. And then the reason being is that it's made by the client. They could, if they thought sales were too low, they could make a fictitious sales order. So I'm going to say this is low quality evidence. And so, you could have a sale with no customer purchase order and just have a sales order. And, that's pretty bad evidence. So, the question is, how do we change that? And we'll talk about that later. Credit approval. This is a control over sales. So this is a control activity. You don't just sell stuff to anybody on credit. You see if they can actually pay for it. And the big thing about credit approval is credit approval be done by, ideally they have a credit department. Just they should be completed by someone not in sales, oops, or accounts receivable. So control activity. Credit approval should be completed by someone not in sales. And people say, well, you say not in sales. Ideally, they'd have a credit department, but if they don't, it needs to be somebody who is not either in the job of creating the sale or in collecting it. Uh, this is more of a control. This isn't necessarily evidence, but you would look at this control to see how much you could, who did it. For instance, if the sales department was approving credit, that would be a real control problem. Okay, pick list. This is a document created by pick lists and packing lists are created by the client. And by themselves, these are considered low quality evidence because they can make them up. Make up a fictitious order, make up a fictitious packing slip, uh, you know, um, and the auditors, you'd have to find that. Sales invoice. The sales invoice is different than the sales order. It can't, I shouldn't say it isn't necessarily different, but it can be. The sales invoice is created by the client. The sales invoice should only have items that are actually shipped on it. So, maybe they order, I'm just gonna make something up. Maybe they order 10, I don't know, 10 footballs. Okay, so they order 10 footballs and they only ship 8 of them. Well, the invoice should be for 8. So maybe there's a sales order for 10 footballs. They go to the picking list, they try to pick 10, they can't, they have 8, so they'll pack the 8 up. And so then the sales invoice should only have those 8 actually on there. This is also low evidence though, because it's made by the client. It's made by the client holds it. It could be a completely fictitious sales invoice. Collection of receivables. Collection of receivables is sort of like this up here is a control activity, and it should be done by somebody. Well, let me go right up. Control activity. And this should be done by a collection department. And you want the collection accounts receivable done by somebody in the collections department. An important thing is that write-offs accounts receivable I just say authorized. Oops. Is someone not in sales? Oops. Or accounts receivable. Okay. And so here's the kind of the if you're looking at the documentation, you're looking at yeah, sorry. I'm laughing because my wife's asking, are you teaching tonight? Look around, doesn't see me. Where are you? Yeah, so the customer purchase order may or may not be there, but the sales order is created by the client does not carry very much weight as far as evidence is concerned. Credit approval, if they're committing a fraud, there should be credit approval documents. However, if they're creating a fraud, they can also make those. These are made by the client. Pick list made by the client, sales invoice, collection of accounts receivable. These are all client activities and client documents. I think is bill of lading on the next page. Yeah. Yeah, okay, it's on the next page. Okay, I'm gonna keep the spacing the same. Okay, so you say, well, man, that would be rough then to do a accounts receivable audit. What do? You get all these things all these documents you really can't trust too much. Yeah, all of these are going to be kind of low because these are made by the client. And there will be, there should be evidence of, for instance, credit approval, how do they come up with it and that. And for the most part, companies on the up and up, they will. But it is something that could happen is they could even just make up a client. And, that it would look like they were approved and all that. And so the question is, how do you find that? Well, this is where we get these bill of ladings come in. There's two documents that are very important to us as auditors of when we audit accounts receivable. Bill of lading and proof of delivery. Okay, so let's do bill of lading first. Bill of lading is done when the shipper comes to pick up the goods and they put them on their truck. And it's kind of a strange transaction because I gotta add something else in here. They transfer the possession of the goods that transferred to the transportation firm. Okay. However, the title is not transferred. I'm going to put that as number 6, let's say. Do me a favor, write this in. I don't know why I didn't. So the title of the goods is not transferred to the shipper. So this is, we have possession of it. I'm going to put these two, these two should probably go close together, but I'm just going to put them apart here. Okay, so it's sort of like this, if you think about, like a shipping thing when they, depends. When there's something is shipped, here's the client. And they have, their shipping department. On the screen. Okay. So the shipping department. So here you have your goods. And those are put on the truck. So they have possession of it. The shipper has the possession of the goods. They don't have title, they don't own it. So you ship something to FedEx, you're not actually selling it to FedEx. FedEx doesn't have a title to it. Bill of lading says we have these goods. They're not ours, they're someone else's, but we are shipping these for for them, and we don't have title to it. Now, whoever gets it, they'll figure out who has a title to it when it arrives. But yeah, so it's kind of a strange document in that I mean, back in the day when you handed it to something when they bought it, but when it comes to shipping, that's not the case. Okay, and the bill of lading just pretty much says what was on there. Have a description of what the stuff that is being sold, and whoever is taking the possession of those will check and see that everything on that bill of lading is, it is being loaded onto the truck. So everything that is on that bill of lading, they'll check to make sure it is put on the truck. And this is good because this will be the shipper will be a third party. So the bill of lading, while it may be made by the client, there is a third party, and you can contact that third party. The third party will have a signed shipper. Should also have this document. Also is. So it's made by the client, which at first you say, okay, it's not very good. But it will be actually signed by both of them, and the third party shipper should have a copy of the bill of lading. So you can actually contact the shipper to see if something was shipped. I'm sorry, my gag here. But anyway, now this is actually really good because now you can take something by the client and see if it was actually shipped. You can contact the third party, get a bill of lading from them. Say, here we have this bill of lading. You took possession of this. Yeah, we have it, and we delivered it whenever. But you can take that bill of lading, and now you can go back and compare it to what we said that we put on their truck for them, and you can also compare it to the sales invoice. Okay, were these things that we actually have in the packing list, were they on the bill of lading? That this shipper agreed to. And if it's yes, and then the sales invoice matches up with the packing list and all this. So if the pick list and packing list or packing list and the sales invoice and this bill of lading all match up, that's pretty good evidence because the bill of lading is a third party. That's someone not in, if this is, say IBM, maybe this is, I don't know, FedEx or whoever it was, that there's pretty good evidence that they actually shipped something. Now, it may not have gotten there, but there was the attempt at least made to ship whatever it was and that they counted as a sale. I already talked about this, signed by both parties. And it'll have the seller and buyer addresses. You'll see where it was sent to. That's another good thing because you can see if it was a valid address. You're going to check and make sure that it wasn't sent to a warehouse that's, down the street or something where they're just trying to, not be on the up and up with you, and they actually sold it to themselves. Prices are usually not included. So the values are not usually included in the bill of lading. And notice there's a reason for that, and that is that whoever is taking these, they have no way of knowing what the actual value of it is a lot of times. If they're buying what I don't know, an exotic coffee or something like that, it wouldn't make any sense to them to verify the prices on those. They have no idea what it is. So only the things that they're going to verify. They will verify that this exotic coffee was loaded onto the truck, but they will not verify what the price was. It's not their business. Okay, so these are all things. Now, the bill of lading is the most important one of these two because the bill of lading will show that there was at least an honest attempt at a sale. Oops. So if you can show that, if you can take what they gave you and actually say, okay, look, we did ship it to them. Here's a bill of lading. It matches up. It goes to, here their address. They live in Florida, wherever it was, and that you can match that up with the pick list, the sales invoice, and now you got pretty good evidence that that it was an honest sale, or at least an honest attempt. Now, proof of delivery, we're all familiar with that nowadays, but a proof of delivery is seeing if it actually did arrive. Now, you could have a bill of lading and no proof of delivery, or as in my case, whenever they deliver something to my house, they give, how they give a picture of it. If you buy something from Amazon, they take a picture of it. Like half the time, it's a picture of the apartment building next to mine, and then I have to go over there and get it. But the proof of delivery is, they should be a proof of delivery if they did deliver it, and it should be signed by the recipient usually, especially if this is a commercial account. But proof of delivery is some kind of evidence that they actually delivered it. Now, even if there is no proof of delivery, but there's a bill of lading, that shows that there was an honest attempt at a sale. Maybe the truck was in an accident and is in police impounded or whatever it is. But the big thing is a bill of lading. The bill of lading is evidence that there was actually a shipment made. And if it didn't make it there, there's probably going to be some insurance issue or something that they're going to make a claim for. Any question on that? So, big deal is that the bill of lading is the key because it's a third party. It's a third party that can kind of confirm that the items were shipped. And again, even if they didn't get to their destination, if you say, well, why isn't the proof of delivery more important? This shows that they actually did what they were supposed to do. Now, if something happened, the truck caught fire or whatever, it's not really, that isn't fraud. If something happens to the truck on the way to the delivery, that's not really fraud, or that shows an honest attempt. And quite honestly, there's usually insurance involved in that. So whatever they had the value of it on, they should probably recover it somehow. But anyway, so that is why the bill of lading is a very important one for accounts receivable. Without it, these don't usually carry much weight, because they're all low quality evidence. Bill of lading moves that up. Now there is a confirmation that something was at least attempted to be delivered. Huh? Oh, someone raise their hand? Do you see it? Oh, Courtney?
Yeah, I just wanted to ask, would fraud be possible if the client was in collusion with the third party to make everything?
Yeah, no, you're right, and it depends on how far they want to take it. If they are going to do a fictitious, a sale, and there have been situations where a client has agreed to take stuff to help out a seller, and then with the idea that they will send it back or something like that to boost their sales up or whatever it is. They certainly can get creative with it. They could create a completely fictitious client. That's one way to have a fraud. Also, have been situations, I think I mentioned, where they actually ship it to themselves. I know I'm going to show my age here. There used to be a vacuum company named Regina. That was it was a pretty big company, and you buy all their Regina vacuums at Walmart and everything else. I don't think they're in business anymore. They had a big fraud. And their fraud was that they had this vacuum that was just, it didn't work, whatever, and they couldn't sell them. So they actually would make these fictitious sales, and they would send them to this warehouse. The warehouse, they owned it. So it looked like it was all going to this distribution center for somebody, but it was actually owned by the Regina company, and there was literally like a huge inventory of vacuum cleaners sitting in this warehouse. That obviously, when you make a sale like that, there is a problem with doing that as a fraud. The fraud is you never collect it. Or the problem is, I should say, you never collect it. If you make up a fictitious customer, well, you're not going to get cash from that fictitious customer. Or if you sell it to yourself, you're not going to get cash for it. So the question is, what happens with that? And in one of the things that, for instance, I'm sure you guys have heard of the Enron case, was that they had these, basically making sales themselves, and that they never collected the cash. The cash was never collected. And Enron, when the wheels started to come off, they didn't even issue a statement of cash flows with their financial statements, which is required. It's required by law. They do it, and they didn't do it because obviously they weren't collecting any cash from these fictitious, sales. So there is a problem when this is usually when they start to do stuff like this, when they start make up customers and things like that. It's usually somebody thinking, well, okay, when things turn around, then we'll reverse this back out, and everything will be okay, and no one will know anything about it. But again, fictitious sales, they never get collected. So even if they go through all of the hoops to make sure that this all looks correct, the fact of the matter is the cash won't match up.
Do the auditing, do they have to go through every like cash?
Well, you do try to verify that these are actual, one way you can do it is do external verification, if they say that there's a certain customer, you can actually look up and see that if that customer actually exists and that sort of thing. It's easier nowadays than it used to be, the internet, and they have companies that do it. What's that?
With huge corporations, it
Yeah.
wouldn't be as possible. Like in Amazon.
I'm sorry, what?
In huge corporations,
Yeah.
the auditing that way.
Yeah.
It wouldn't be exactly possible.
Well, you can still see their customer list and verify the whoever they made these sales to. And a lot of times oftentimes large companies sell to other large companies. For instance, even though you take a car manufacturer, yeah, they have thousands of dealerships, but 1,000 dealerships isn't too bad. You can actually look up, you can take a sample of the dealerships, look up, make sure they're valid dealerships, and see that they are selling these cars to these valid dealers. They would make usually you would certainly do it on a sampling basis. And a lot of times, even if they had thousands of them, if you took a sample of say 100, you could probably get into the 90s, 95% level. Because, another thing is, if it's a large account, you usually test all of the large accounts. If it's a smaller account, you take a sampling of them. And the problem with that for someone who's committing a fraud is that you have to do more of them. If you're going to move the books and you're going to do it with small accounts, you have to do a lot more of them. The more of those you do, the more likely it is to get caught, because the more likely some of those will end up in the sample. So yeah, if they do it, okay, let's have this big, large, fictitious client. Well, that's going to be 100% sure almost of getting caught, because the larger accounts will be audited at 100%. I don't think it did. I don't know. I'll look and see what we did on the other one. Okay, aging a trial balance. Aging a trial balance. This is basically seeing the value of accounts. What account? How much are these accounts going to be worth? And I'm just going to make up an example here. Oops. First, I'm going to mess up my screen. Then I'm going to do the other. Okay, so for instance, we'll have accounts receivable. And I'm just going to make up a few strata here. I'm going to say that these are we have current ones. Accounts receivable. And how much do we have in those? I don't know. Let's make up a number. 100,000 in the current accounts receivable. Okay, accounts that are 1 to 30 days, 30 days past due. Let's say that we have another 25. Hold on a second here. 25,000 of those. And let's say that we have over 30 days. So 31 days up. How many of those? Let's say those are 10,000. Oops. What we'll do is we will estimate how much of those will go bad. So estimate uncollectible. So let's say that the 100,000, the estimated uncollectible is, I don't know, 2%. So of the current ones, we think that 2% are going to go bad. I have an account error. All right. 25,000. Is it going to be, so if it's 1 to 3 days past due, is it going to have a higher estimate uncollectible or a lower? Will more of these go bad most likely or fewer? What do you think?
Less chance,
I'm sorry?
lesser chance.
They're probably going to have more. If they can't pay them off on time, you know, the longer out you go, the less likely it is to be caught. So, or that they will be able to pay. So let's say that it's 10%. I'm making these numbers up. I mean, I'm not doing anything. I'm not doing any real calculations here. And past due, you know, over 30 days past due, you know, it's going to be some higher number. I don't know, let's say 30%. So as time goes on, less and less. I've done audits where there's been accounts on the books that have been years old. You tell them get rid of those, and yeah, it's like if you haven't, you know, it's been 4 years. Yeah, you know, is the person even alive still? You know, all right. So our estimate of bad debt would look like this. So this would be an aging of accounts receivable. We take them and we age them. We say, okay, the longer they're out, the less likely they are to be caught. What's 10%? 2,500? So this would be our estimated uncollectible. Oops. Yep. Yeah, so the longer things go are past due, the less likely are you going to collect them. So we would add these up, and this would be, what is that? 7,500? Okay, so this is an aging of the trial balance, and this is how you kind of estimate what this should be. And by the way, one of the ways that they see, you know, if you're auditing a company, you want to make sure that this estimated amount is appropriate. You could actually go through and see what was, you know, collected and written off in the past of these accounts receivable, and see if what they have is reasonable. You know, see if the 2% is reasonable, see if the 10% be the 30%. And by the way, the clients should have those documented. Is this right, 7,500? Yeah, it is. Okay. So this is an aging of accounts of a aging trial balance of the accounts receivable. Okay. I know what's funny looking about this one. I changed where this is. That's why it looks strange to me. Okay. Industry average of bad debt. One of the ways you look at the bad debt is to see what the industry average is. Now, it could be that your client has a little bit different aging of account, that their amounts that they're receiving have for bad debt are different than the industry, but they should have reasons why. It should be if it's higher or lower. So the industry average reasonableness. Is that a word? I don't even know. Reasonableness? Must be, right?
Yeah.
Now, if they have any number of clients, if they have a number of clients, you are going to have some bad debt expense. If you only sold things to, multimillionaires, you're not going to make very many sales. You're probably not going to be in business long. So you have to sell the normal people, and things happen. People die, people leave the country, people, whatever happens, things happen. People go bankrupt. So there are going to be some bad debt if you have a fairly large customer base. It's going to happen. When I worked at Navistar, we made diesel engines for Ford, and this is I don't even know if it's still open. It was an plant in Indiana and Indianapolis that we made all the diesel engines for their trucks and stuff. But anyway, so our customer base was Ford, took 90 some percent of our production. So all of our accounts receivable were basically for Ford. There was some boat manufacturers and some other things. Those are the accounts we really made money on. But generally speaking, for Ford, that's more of it was more of almost like a internal business thing than really an accounts receivable. But so the bad debt expense for Ford was really not something we worried about. But we did have to look at the boat manufacturers and things like that. Okay. Sales journal reconciliation to the accounts receivable ledger. And this is to make sure that the sales journal matches up with the accounts receivable. And it is possible that they may put fictitious things on the sales journal to make their sales look better that don't end up going into the accounts receivable ledger, and that can be a problem. So matching credit sales. I don't think I've talked about accounts receivable ledger. Actually, this would be a good time to talk about it. They have them for sales usually, and they also have them for accounts receivable. They'll have other ones we'll talk about. I'll do it on the board. Or maybe. It's basically like this. Okay, so here's our journal entry for a sale on credit, right? Here's our journal entry we have. And if you just have one of these every now and then, it's not that big a deal. But suppose you have hundreds of these a day or even thousands. What they usually do is have for instance, a sales journal. And the sales journal will look like this. I'm making a bunch of journal entries. Okay. You will have, customer A, B, see whatever customers you have, and they will have a list of what they buy. And you'll go down this list, it could be hundreds of them, but let's just say there's 3 here just to make it easier to. So if this was our sales for the day, oops. We would make a journal entry that looked like this. Accounts receivable, 1,400, our accounts receivable is going up, our sales are going up by 14. So it would come from the sales journal. All of them are going to have the same journal entry, so it would look like this. Okay, so you go, okay, well, that makes sense. Well, there's another thing though that happens, and that is going back to the you're going to also have an accounts receivable subsidiary ledger. So this is a ledger that's going to keep track of the accounts receivable. And, so you're going to have an accounts receivable ledger, subsidiary ledger. All of these should be on that ledger. You should have for A, 500 gets added to A's account. B, 600 gets added to B, and C gets for 300. So what's on the sales journal, this is going to be what goes into the general ledger, one journal entry for all of them. The subsidiary ledger will have each of these individual ones on it. And this is when you have a big, you have a large number of sales. They almost virtually always will use a sales journal. Make all the sales, everything goes in as the same journal entry, whatever, the daily entry for the sales journal goes in as one journal entry. These are the sales for the day. But the detail in the accounts receivable ledger, the subsidiary ledger, will have each of these individuals on it. And so this is what you're kind of reconciling, making sure that all of these are actually over here. Because if they just made up one, where's C? If they just made up a sale to, bump up the sales for the day or something, if it's not on there, that's a problem. Okay. There's other, those are what they call special journals. And they're also, they do them for purchasing. They do it for other things that you do a lot of. A lot of times they'll have, they call these special journals. Sales and accounts receivable cutoff. Actually, we're going to go through that later. Am I lying to you? No, I'm not. Generally, you do the sales cutoff. Let me put this in here. So sales and accounts receivable cutoff. Usually the last bill of lading is used as the cutoff of sales. So the last bill of lading at the end of the year, I should say at the end of the year. And so on December 31st, for example, you'll go and see what the last bill of lading, what the date was on it. For that one, when it was actually, not like usually, I'm gonna have a comma. Usually the last bill of lading is used as the year. So the last one that we actually sent out will be what we use as the cutoff. Any bill of lading that is dated after year end are not counted as sales. So if there is no bill of lading that they got put on a truck and by year end, it's not considered a sale. And notice that there is a, this is a real important cutoff because it determines your sales for the year. It determines your accounts receivable that you have in the books for the end of the year. It also has your inventory because if it is sold, any inventory that is sold is not your inventory anymore. So, not only does it have your sales, make sure that your sales and your accounts receivable are correct at the end of the year, but also your inventory, because the inventory that is on those bill of ladings is sold. Anything that was in a bill of lading after that is not sold and is in your inventory. So, big accounts, sales, accounts receivable, and inventory are all tied to this cutoff of at year end. Oftentimes, companies, depending on the size of the company and all that, someone they'll have auditors right on hand at year end to record that last truck leaving with the last bill of lading. And yeah, it's a very important number because it affects so much the financial statements. Anything not sold at year end should still be in your inventory. Okay, bill and hold. I almost don't like talking about this because there are very stringent rules on it. Bill and hold criteria. Generally, these are not allowed. And I'll tell you what those are in a second. So bill and hold. Generally speaking, these are not allowed. And you say, well, what are these? Bill and hold is where someone says they want something, but they don't want you to deliver it. So, here's your shipping dock. You have your goods. And here's your shipping dock. And there's to be sold, a truck has to show up and they have to put it on the truck, and then you get that bill of lading. Okay, so a bill and hold is where they say this. We're not gonna don't ship it to us, we don't have space for it or whatever. You're just gonna sit there and put a tag on this that says sold. And it'll be sitting on the shipping dock separated from everything else. Generally speaking, this is not allowed. If you still have it, it's not allowed. The only the criteria for it is that these must be able to be billed, and that the bill and hold is at the request of the customer, but there also has to be proof that they are going to take it unconditionally. And if there is not the unconditional proof that they are going to take it, it's not allowed. They really tightened up on these things. In the past, people would mark stuff sold, and it's really not allowed anymore. There are a few exceptions of this too. If there's something that's completely customized, that can only be used for one purpose, and if that's the customer that has it, that's another thing that can be sometimes used as a bill and hold. But generally speaking, those are not allowed. Okay, this will be the last thing we cover in this today. Yeah, we'll stop here. Pledging accounts receivable. Pledging or even sales of accounts receivable. They're pledged as collateral. Or loans. So sometimes you go to the bank and they'll say, yeah, look, we need cash. And they say, yeah, okay, fine, but we need some collateral. And they say, how about these accounts receivable? And as these accounts receivable are collected, the money goes to the bank. And what this comes down to is the um, management's assertions. Yeah, I'm sorry, let me change that. Relevant assertions that you have to check on. And the relevant assertion that you're really looking for are rights and obligations. And the relevant assertions, and those are because even though they have these accounts receivable on the books, they may not be able to collect them, or if they collect them, the money goes directly to the bank to satisfy loans. So it can be a problem. There's rights and obligations. So even though they are valid accounts receivable, they may have been pledged as collateral. And pledging them as collateral will generally take the possession of them, I should say the rights to them um, off the book. It can take the rights of them off the books for the client because they're offset by the loan. So pledging accounts receivable, when you do testing for this, these are the relevant assertions kind of thing, that the rights and obligations, they have a right to collect those. And there could be obligations for the bank note that goes along with those. Let's stop here. We'll start with confirmations next time. So, and by the way, just so you know, next class is the last class before the Thanksgiving break. And we will finish up this handout, this chapter 11 handout. We don't have that many classes left. I think there's 3, 4. But anyway, yeah, so and we will get to the chapter 12, which is inventory, and chapter 13, which is property, plant, equipment. That one will be those are combined. Okay, I'm gonna go ahead and save this. The next thing we're gonna cover when we come back from break is sampling overview, which we started. Okay, yeah, so we'll when we come back, we'll do this. So let's say be back at it's 7, so let's say 7:10. Be back at 7:10. And we might finish this tonight, I'm not sure. I should know this, shouldn't I? All right. All right, so we'll be back at I'm sorry. I was muted. Thank you. Thank you, Courtney. It wasn't very good anyway. It was just mumbling. Okay, so substantive tests are, I'm gonna break this up into two different things here. So these are to find the actual dollar amounts that the financial statements are off by. So, and we talked about this before, they're off by 100,000, 200,000, whatever it is. These are to find dollar amounts that they're misstated by. Monetary unit sampling is a similar type of sampling that we're not going to cover in this class. It's kind of fallen out of favor a little bit. When I was going through, it was a big deal, but it's no longer that way. By the way, this whole handout, I don't know if I told you this or not, but this whole handout kind of comes about when I started teaching the CPA review. I taught the CPA review up so from like 1995 to 2000. And then then I didn't teach it again till like 2011. I know this is like when you guys were born, but anyway, they had changed the exam, and so that's why I'm putting this stuff, this whole sampling overview and test controls, this whole handout is sort of the things that they've kind of focused on lately on the CPA exam. So classical sampling is what we did, and they actually test this a little bit in there. Monetary unit sampling is another type of sampling that we are not going to cover in here. It's tested much less frequently on the CPA exam. I think there's sometimes it's not tested at all. But anyway, monetary unit sampling, it's good for a few different things, but it isn't tested nearly as much as it used to be. So classical sampling, anyway, both of these are to find dollar amounts. What are the misstatements, the dollar amounts of the misstatements? Okay, now, attribute sampling. This is probably the most important one of this handout. Attribute sampling, this is when you sample for attributes like Tussa controls. Do I have the other handout? It's still up here. Okay, so for instance, going back to the previous handout, you don't have to go back to it. I'm just going to put it up here on the screen for a second. But some of these, for instance, this credit approval. This is a control activity. How do they approve for credit of the, for customers? What you might do is take a sample of the credit approval process and see if it's working like it's supposed to. They're saying that they do, these 5 things for credit approval. Let's go check and see if they do. And it's either yes or no. Did they do these credit checks? Do they actually do a check to see what they're, they get bank statements, and do they actually do a check based on, tax reports or tax returns and all that kind of stuff? And it's yes or no. Do they have these documents that they say they're looking for? And the reason why we might want to do that is if we get comfortable with the controls, it might reduce the amount of items we need in our sample. It might reduce some of the testing. So attribute sampling are for tested controls, and we do this so that we can save money basically on testing for dollar amounts. So here's what they are. Attribute sampling. These are yes or no tests. They are used to determine if the controls can be relied upon. So these are yes, no tests. There you see the controls can be relied upon. And let me give you an example. For example, here would be a control. All purchase orders must, be signed by a manager. So this is a control. All purchase orders must be signed by a manager. So a manager has to say, yes, this is my purchase order and I approve it. So a manager must sign all these, all purchase orders. So how would we test that? So here's the control. All purchase orders must be signed by a manager. How would we test to see if that was actually happening? Yep. Yeah, take a sample of purchase orders. And verify that a manager had signed them. So this is your test. How do you test it? You say, okay, well, take a sample purchase order and verify the manager has signed it. And this will be a yes/no test. Did they sign it or didn't they? You know, if they signed it, it'll be yes. If they didn't sign it, it'll be no. And so these are sampling for attributes. The attribute would be, in this case, manager signature. Does it have that attribute? Yes or no? Now, the type of testing this is known as a binomial. No, it's yes or no. There's a type of statistic it is, binomial distribution. Now, binomial distributions are really a pain to use if you do it the way they're supposed to, you know, they actually are supposed to do the binomial sample. I'm not going to go through it, but it is, if you want to look at something fun, look and see how they actually figure those out. Now, there is a way around it though, and that's what we're going to talk about next. Okay. Yeah, I'm frozen. So there is a way around having to do the binomial distributions, which again are not fun, and especially if you start getting to larger numbers. And that is, there's a thing called the central limit theorem. And the central limit theorem says that any distribution when repeated, be an H in that.
You're blurred out. You're very blurred out.
Oh, I'm blurry. I'm gonna see if I switch cameras and then go back. There, see, I'm not blurry anymore. Thank you for letting me know. So central limit, any theorem, or actually any distribution when repeated will become a normal distribution. And the normal distribution is nice because we have all kinds of formulas for it. So any distribution, you know, whatever wacky distributions you can have, you know, it could look like this, it could look like you know, like this, or whatever it is. If you do it enough times, it's going to end up looking like a normal distribution. Like that. And for instance, let's do a coin flip. Coin flip is a binomial, heads or tails. So coin flip will have heads or tails. Flip a coin. It's a binomial, and if there's one flip, you will have two possibilities. It could be a head, or it could be a tail. So one flip, you'd have a head or a tail. When it's repeated, two flips. There's a possibility that both flips are heads. There's a possibility that both flips are tails. There's the possibility that the first one is a head, and the second one's a tail. And if you don't care about the order, and we don't in this case, it's also a possibility that it could be a tail and a head. Even after just two flips, we start to get a normal distribution. And that's why the central limit theorem is so important, because any distribution, no matter what it looks like, if you do it enough times, it's going to end up looking like that. And that's why in stats class, they beat up that normal distribution so much, because repeated distributions will end up looking like that. So you'll have this, 25%, 25%. Each of these is a 25% chance. So this will be a 50% chance. And you automatically start coming up with that normal distribution. And so when you actually do your picking your sample size and all that, you're going to use the normal distribution, which again is a lot easier to use than the binomial one. Okay. When I first started teaching this, I started to go through the binomial, and I think, you know what, we're not going to do this. This is too much. So this is where the accountant, the auditors pretty much live, is on these two things: the attribute sampling and usually classical sampling, but it could be this one too. But for the most part, classical sampling and attribute sampling is where we spend most of our time. Okay, discovery sampling. We're going to talk about this one, but not very much. Discovery sampling is when you are looking for a certain characteristic, and for us, it's usually fraud or errors. E. And again, usually it's for something like fraud. There's a few different ways you can do discovery sampling. We're not going to go into too many of them, but one of the ways that they use is, okay, let's see if we think there might be fraud in a certain account, we can go through that account and we'll look for items that have fraud, that have the characteristic of fraud. So a lot of times it's used like this: if you take 100 items, oops, without fraud, you may come up with something like you are then 90% sure there is no fraud. Okay. And the more items you take without finding it, oftentimes, there's other ways to do discovery sampling, but let's say there's 200, if you get 200 items without fraud, maybe you're 97% sure. So the more items you take without finding fraud, the more sure you are. Let's see here. So if we go through 100 items, so let's say someone gives you a tip that there's fraud in the, oh, I don't know. There's fraud in a certain inventory account or something like that. You might go do some testing and see, okay, you know, and they have tables for this. There's all kinds of tables you can use, and there's different ways of using the tables. You can also use it to see how much of it is fraud. If there is fraud, how much of it is fraudulent based on if you do find any items. But a lot of times they'll look for things that, you know, how many items you pick without fraud, and then you can be certain, you know, you get to 200 items with no, you're 97% sure. That might be enough to say, okay, you know what, this is probably not a very good lead. There's only a 3% chance that, you know, this exists. So, okay, dual purpose test. This one is really, it's not really a sampling item itself. It's more how do you pick your sampling? And the idea is that you can actually use some items in the sample for two different things. For instance, let's say you're going to do attribute sampling, so test the controls. I didn't write that in here. Test the controls. Write this down. Oops, don't write it incorrectly like I am. So test the controls. All right, so let's say I'm going to do some attribute sampling. We get test the controls. And I'm going to do some classical sampling. And I'll clean this up in a second. Okay, let me clean these up. Okay, so I'm going to do some test controls, and maybe I'm doing some test controls so that I can see if I can rely on these controls. I want to be able to rely on the controls because it can reduce the amount of these tests down here, the substantive tests. So I want to rely on the controls. And suppose I have sample size needed. For each of these. Okay, so I need to get a sample of these, and the sample looks like this. I need 100 for my attribute sampling. And I need 450 for my classical sampling. So I could pick two different samples. One would be 100 of them, pick a random sample of 100 items for attribute sampling, see if there are, you know, you see if the purchase orders are signed by a manager or whatever it is. And then I can go to my classical sampling where I just pick the items themselves, look at the dollar amounts, and I need 450 of those. Now we do the attribute sampling first. This is the order we do these in. Why? Because we want to reduce. Oh no, don't do that. We want to reduce the classical sampling. So if we can get comfortable with, you know, the controls are working, then we can reduce this classical sampling. So we're going to pick this first. So we do the test of 100 items. Now, let's say we're okay with the controls. We say, okay, we can trust these controls. We go to classical sampling. We're picking a sample of 450. To be more efficient, what might we do? Instead of going and picking 450 new items, what could we do? Well, we already pulled 100 of these for attribute sampling. We can use the 100 from the attribute sampling and just pick 350 more for classical sampling. So what we could do is take, the test of controls, hundred items, plus 350 new items, and that will give us our 450. So what we can do is, instead of simply discarding those 100 when we're done, we can do what they call dual purpose. We'll use these 100 for both. Yeah. So this 100 will be a dual purpose. We're going to use them for our attribute sampling. Then we're going to use them again down here for the classical sampling. We're not going to pick 450 new items. We'll just pick 350, and then we'll also use those 100 that we picked for the test controls. So that's what a dual purpose test is. It's when you actually do, it's sort of like getting two samples with one stone. You're going to use those 100 for both the attribute and the classical. So you do your attribute sampling, you decide you can rely on the controls, and then you can do your classical sampling of 450. Here's a question for you. Suppose you do the sampling of 100 items and you find out you can't rely on the controls. So you planned on doing 100, you thought you could rely on the controls. You can't rely on them. And if you could rely on the controls, you could take 450. So what are you going to have to do with your classical sampling if you can't rely on the controls? What do you think? So if you could rely on the controls, you'd only need 450, but you can't rely on them. So what are you probably going to have to do?
Start over with and use 450. Start over and begin with 450.
Well, you could. You'd probably have to take a bigger sample, right? If you can't rely on these controls, you thought you could rely on the controls, but you find out, you go through the testing and you find out you can't. So if you cannot rely on the controls, you must increase the classical sampling, or the substantive testing, I should say.
So then you would go to 550.
Exactly. You're
Okay.
going to increase it to some amount.
Okay.
So usually when you do testing like this, though, you're planning on relying on the controls. Okay, if you right from the beginning, if you don't think you can rely on the controls, you're not going to bother with it. But if you think you can rely on the controls, but you cannot, you do the testing and it's like, oh man, then substantive testing will have to be increased. Let me get a little room here. Okay. So if you can't rely on the controls, for example, you had to get more than 450, and like you said, maybe maybe 550. Eh. So you're doing it to reduce your, the amount of testing you do, but if you can't reduce the amount of testing, then you go, okay, well, I can't just use 450. If I could rely on the controls, I'd use 450, but now I need more 550, 650, 7, whatever it is. It's gonna be some, and it's gonna be a judgment call. I think I told you guys that, all of auditing is judgment. And even if you say, okay, I'm gonna do it to the 90% level or 97% level, whatever, that's a judgment call. Even if you can quantify it, it's still a judgment call. Is 90% good enough, or is 97 what you need? Or, these are judgment calls. And same thing will be down here. How sure do you want to be? You can't rely on the controls, and you'll, work up some kind of numbers to figure out where you're at. Okay.
It would be risky for people who are auditing to make a judgment on it.
It is, but it's all judgment though. And that's why it's hard to teach. It's hard for people to, I'll tell you honestly, when I was in auditing, I probably audited for about 3 years before I really understood it. Because it is all judgment, and it's, and like I say, even if you work out your audit plan, you say, okay, well, I'm going to audit to the 95% level. I got to pick a sample of 178 items or whatever. Well, it's a judgment call to know what level, 95% level or whatever. So it's all judgment. Which tests you're going to do, what controls you're going to try to rely on. There's educated guesses, but at the same time, and I can't tell you how many times we've gone in and think, oh, this will be a piece of cake because this is, from last time and it's a mess. Or the other way around, gee, we really got to do a lot of testing here because this is going to be a mess, and you end up, oh, everything's fine. The testing actually is this. And by the way, the testing costs a lot of money. If you're wondering why we get, well, big deal. We can use them for both. Testing is a lot of money. This is where the money is spent on doing this testing. Probably about a third of the cost of an audit is the testing, which is huge. Yeah, and you're talking about thousands and thousands of dollars, if not millions. Okay. We'll go over this. Let me see. I think we'll stop it to that because I want to do this all together. Okay, but let's go over this one real quick. And this is kind of the basic. This is very similar to what you have in a statistics class. So sampling risk and allowance for sampling risk. If you take a sample, there's a risk. There's a risk that your sample does not match the true population. And there's nothing you can do to get around that unless you give up on sampling and do 100% of everything. There is nothing you can do about that. And by the way, just to, not to put too fine of a point on it, but if you audit to the 95% level, that means that 5% of the time you're going to be wrong. It has to be. If you're auditing the 95% level, that means 1 out of every test that you do is going to be wrong. Now, if you come up with it, there is a problem with a sample. It's possible that it's just that 1 in 20 that we talked about that is wrong, and so you get a bigger sample. And if it is that everything is okay, the larger sample you take, the more sure you are, the more likely that it's going to show that that the first sample you took was in that 5% or whatever. Okay. So again, sampling is, and that's just part of sampling. And there's nothing you can do to get around that. So sampling risk, there's really nothing that you can do to change that. So how do you get, well, you've got to the 95% level, how do you get rid of that 5%? Not unless you take 100%, there's nothing you can do. So sampling risk is for any sample that is taken. And it's not a mistake. It's not a mistake. It's just the way it is that if you take a sample, there's a certain percent of the time you're going to be wrong. As to what level you're wrong, I mean, that depends on, how sure you want to be. Okay, so an allowance for sampling risk, the precision, these two kind of go hand in hand. And here is this is something you'd probably see in a stats book. You have an accounts payable as a projected value of 100,000. And a standard deviation of 5,000. Okay. So if it is one standard deviation away, this would mean that you are 68% sure that it's between 100,000 minus 5. So this will be, I'm just going to put in 95. So this will be 95,000. Where's my K? Here it is. And 105,000. You would be 68% sure based on this projected value of 100,000, standard deviation of 5,000. You'd be 68% sure that it is 95 to 105. Now, if you want to be more sure, it's going to be a wider range. So two standard deviations would be 10,000. So this would be 90,000. To 110,000. So if you want to be 95% sure, and of course, all the way up to 99.7, almost close to 100% sure. I'm going to sneeze. I'm warning you guys. The nice thing about doing Zoom at home is you can turn off the camera, turn off the mic, and then sneeze. You can't do that in the classroom. Okay, so this would be, let's see, 100,000 minus 15 is what, 85,000? And 115,000. So the more sure you are, the wider that allowance for sampling risk is, given the same sample size. So given the same sample size, the more sure you are, the wider it's going to be. If you want to be 68% sure, it's only 5%, it's only 5,000 one way or the other. As you go up here, it gets wider and wider and wider. And so, maybe at 68% sure you're at 95, you say, okay, well, if this is off by 5,000, that's not a big deal. We can handle it. That's not material. The more sure you get, if you want to be 99% sure, that would be at 85%. You'd be talking about this account possibly being off by 15,000. Now you might start questioning it. At the 99% level, it's a different ballgame. That you're not as sure that it won't be materially misstated. Okay. Wow. Oh, I got it down here. What am I doing? Why did I do all that up there? Anyway. So yeah, for the same sample size, a lower sampling risk will have a higher allowance for sampling risk. So the allowance, if your allowance is 1%, you'll have a higher than if it was 5%. So here's our sampling risk. For this one, it'd be 6.4. And it'd be plus or minus 10,000. And as we go up, or as we get it tighter, we reduce that, the allowance goes up. And that's just sampling. That's, because if you look in a sampling book, it'll show you something like this. Okay, a larger sample size can reduce the sampling risk and the allowance for sampling. So one of the ways that we can if we want to tighten this up, is to take a bigger sample. And it'll sort of look like this. The closer you get to taking 100% of items, the narrower that gets. So for instance, if we're here, it looks like this. If we take a bigger sample, this is going to narrow up. This is going to narrow up. So maybe it'll look like, this. And maybe we'll get even a little bit different, maybe this will be 102,000 or whatever it is. But the more items you take, the closer you get. And if you get to, if you do 100%, it's just going to be, whatever you come up with. But as you take a bigger sample, it closes in, and notice that the wings will come in. Huh? It's blurry. All right, let's we don't want that. Hold on a second. What a goofy picture. I gotta get a different picture. Okay. Is that how I look? All right, yeah, so hopefully you guys can see this. Yeah, so the larger the sample size, it'll tighten that up. And so if you want to know how to bring that together, that's how you do it, is by taking a bigger sample size. So if you're at the 99% level and you don't like that it could be off by 15,000, you take a bigger sample, it might tighten it up, to some lesser amount. And probably it could very well give you a different a different amount that where you would think it might be off, and maybe it goes to 102 or something like that. And then you would take it from the plus or minus from the 102. Okay, let's stop there. And I think we should be able to finish up both these handouts next time. And yeah. So let's stop. So next time, and then that'll take us to the Thanksgiving break. And so next class, I should be able, I might just give you two exams. Would that be right? The accounts receivable one, which won't take long, and then the sampling one, which probably won't take too long either. So we'll do that next class. So I'm going to stop right here, and I just want to ask: is there any questions on the exam itself? On the chapter 10 exam? Where am I at? Is there any questions on the chapter 10 exam? It's due, I think, Friday.
Yeah.
I think some people have turned it in already. By the way, I usually don't grade those until the day that they're due. And after the grades are in, you can't change anything. But up until that time, you can. So if you already turned in the test and you take a look at it again, and you say, okay, I want to change it, you can just put in another copy of the test, and I'll go to the submittal number 2. These have unlimited submittals, so you can put in as many as you want, and I will just go to the last one. Any questions on the chapter 10?
No questions.
Okay. Don't say anything. You're gonna keep rambling on. All right. Well, I will see you guys next week. And the job for this week is to get the exam in. That's it. Next week we'll turn in all the stuff, and then I'll probably end up sending out 2 tests. I'll probably give you an extra week on those 2 because there's gonna be the Thanksgiving break in there. So any questions?
No, sir.
Okay.
No, thank you.
Thanks, guys. Talk to you later.
Thank you.
Have a good night,
Talk to you
everybody.
later.
Good night,
Bye-bye.
everybody.
Good night.
Good night.
Good night.